Hi everyone, this is Guang. A little bit about me is that I left Canada 2 years ago and I'm working in the US right now. And I personally make a lot of tax filing mistakes. And tonight I just want to share with you guys the learnings that I got from dealing with my tax filing. And in this talk, I'm going to break into two parts. Part one is the things you have to do for your first tax filing after you left Canada. And part two is what are the implications for being a non-resident of Canada. So let's get started. And now, if you're about to leave Canada, these are the three things you have to keep in mind. Number one, you have to keep in mind on the date that you become a non-resident. What this one means is if you are single or you don't have a strong tie with Canada, this usually means the date you left Canada. And if you have a spouser, it's the date the spouse left Canada. That's the date you cut your tie with Canada. So make sure to remember this date, as this date is significant. Basically, your income received before this date, you still need to report to Canada. But the income you receive after this date, you don't have to report to Canada. So make sure to remember this one. It saves a lot of money, trust me. And and then number two is when you're filing your taxes for that tax year. For example, if you left Canada in 2017 and now you're filing the tax for 2017, that's your tax year, and you have to make sure to file a tax exit form. This form is it's just indicate the date you left Canada, so that they can count your income in based on that date. Make sure to file this one. This form is important. And now let's talk about number three. Number three is not applicable to everyone, but it's applicable to someone has property or owns some property value worth more than $25,000. That's the cutoff. And if you own property, stocks or whatever that's more than value of $25,000, you have to submit a form that's called disposition form, which means you have to report your tax gain, your property gain, and etc. But if you're not selling the property, if you're not selling the stocks, you don't have to report a gain there, but you just need to file the form. So for example, if you have a house that you bought there and you're not trying to sell it when you leave Canada, you still have to submit the value, such as how much money you pay for the house and what's the current market value for the house. You don't have to pay tax on the capital gain on that, so don't worry about it, but make sure to file it, as if you forget to file this one day the penalty is $25 and it can up to $2,500 maximum. So right now, why don't we just move to the second part of this talk. The second part of this talk is all about the implication after you become a non-resident. A lot of question and concern I had when I just become the non-resident is my RRSP account as well as my TTFA account. Those accounts, my concern is, do I have to close those accounts or I can keep it alive? And the answer I call CIA is that we can keep those accounts, but the only implication is we cannot make any contribution to RRSP and TTFA because those are for residents of Canada, and now we consider as non-residents, so therefore we cannot make contribution. Make sense? The other implication is more not that intuitive. It's basically if you still have income coming from Canada, such as you didn't sell your house and you rent it out, and then that part of rental income, you are responsible to pay tax for it. And the differences between if you are a resident of Canada, you pay the tax after. So you pay the tax at the end of the year when you file tax, but if you are non-resident of Canada, you pay the tax upfront. So they call it tax withholding. What this one means is if you receive that much revenue, you automatically deduct 25% of you automatically pay 25% of that revenue to a non-residence account that assigned to you. You have to call CIA to set up the non-residence account, and they're going to give you a number. And if you have a house to rent out, and every month once you receive the rental income, you pay 25% of that rental income into the non-residence account. And because this is based on the revenue you receive, which means at the end put how much cost it actually the property incur. So at the end of the year, you can submit the cost, and you can reclaim part of the money back, because now the tax rate is based on your net income, but not based on your net revenue. And now if you incur some cost, you can of course pull it back to claim it back. So this pretty much about the talk. And in this talk, just a quick recap, I talk about two parts. Part 1 is things you have to do for your first tax filing, and part 2 is the implication after you become a non-resident. I hope you enjoyed this video, and if you have any more questions, then please feel free to comment. I will try my best to answer it. Hope you like this video, and if you like it and subscribe. I will talk about my other learning and other things that